Almost every trader watching this video already knows about these candlestick patterns and uses them to take trade entries. However, in most cases, those entries don't work out. For instance, in this chart, the market moves within a range and then breaks below it. The moment you take a short position after spotting a bearish engulfing pattern, the market suddenly reverses, leaving you trapped. In the same way, you might often open trades after identifying candlestick patterns on the daily chart. Yet most of the time, they fail to generate profits. That's why, in today's video, we'll explore some methods to recognize candlestick patterns correctly and enter trades at the right levels. Before we continue, if you find this content useful, make sure to hit the like button. And if you're new here, don't forget to subscribe and turn on the notifications so you never miss our latest videos. I'll catch you right after the intro and disclaimer. Every candle that forms on a chart represents four essential values: the opening price, the high and low points it reaches, and the final closing price. The candle's size and movement depend on these values. The wider the gap between its opening and closing prices, the longer or shorter the candle appears. When a candle closes above its opening level, it signals buyer dominance. Conversely, if it closes below the opening price, sellers are controlling that time period. For instance, this 5-minute bullish candle closed higher than its opening level, showing that buyers held control over this 5-minute span. The following candle also opened lower but managed to close higher. However, the next one opened higher and closed directly below, meaning buyers led the first 10 minutes. But sellers took over in the next 5. So, have sellers completely overpowered buyers here? If we only analyze the last 5-minute candle, then yes, sellers appear dominant. Now, many traders might wonder, should we enter a short position now? The answer is no. Entering a short trade here would be a mistake. Because if you merge these 3 candles into a single 15-minute time frame, you'll notice that the candle closed nearly at the same level where it opened. This shows that neither buyers nor sellers have gained full control, as the price ended at the same level where it began. Take this 5-minute as an example. After a period of consolidation, the price breaks downward, forming a bearish engulfing candlestick pattern. Looking at the last 2 candles, sellers appear to have gained control. Observing this, many traders jump into short trades, but in my opinion, this is a completely wrong entry. When the price first breaks its earlier support area and drops near this level before reversing to create a new swing low, it suggests there are still active buyers defending this zone, preventing the market from falling further. For a valid downside move, the candle must close below this level. However, the red candle here closes within that same zone, meaning sellers couldn't maintain control. We should therefore wait for a candle to close below this point. Instead, the next candle closes higher, with the price moving above the previous rejection level. This confirms sellers failed to push prices down. As a result, the market, after taking out buyer liquidity, also consumes the liquidity sitting at higher levels. A psychological level of 55,000 also lies in the lower zone of this chart, acting as strong support. Until this level breaks, fresh sellers won't step in with strong momentum. Hence, you can't rely solely on candlestick patterns to enter trades. Doing so often leads to losses instead of profits. While many traders today understand technical analysis, most still struggle to identify the right entry and exit levels during live market conditions. On any chart, you usually notice 3 candles forming during a bullish or bearish trend. This specific candle is often referred to as a big bullish or big bearish momentum candle, where either buyers or sellers gain full control of the market. Because of this one-sided control, it's also known as a one-sided dominance candle. These candles appear on charts when strong volatility drives sharp momentum in the market. However, they often end up trapping retail traders. For instance, a big bullish momentum candle forms around 9:50. Since it appears right after price consolidation, many retail traders mistake it for a range breakout candle and enter long positions at the breakout. But soon after, the price drops, triggering their stop loss and causing a loss on the first trade. After this brief decline, another large momentum candle forms on the chart, just like before. Believing that this time the price will definitely reverse and move higher, Traders enter the trade again. Yet again, the market moves downward, hitting stop losses and resulting in another loss. This leads to frustration. Now, after losing twice, you decide not to enter any trade until the range clearly breaks, waiting patiently for a confirmed breakout. A little later, the market forms another large bullish momentum candle, appearing to break the range exactly as per your analysis. The moment you enter a long trade here, the price reverses sharply downward. Because of this single candle pattern, you end up getting trapped 3 times in one day. Large institutional traders intentionally use such candles to trigger panic and create FOMO among retail traders, manipulating emotions to force them into impulsive trades. This activity builds liquidity on the chart, allowing institutions to execute their own positions easily. Therefore, whenever you notice candles forming that are significantly larger than normal ones, it's best to stay away from them. These types of candles tend to deliver profitable trades only once out of 10. And if you doubt this, just open a chart and verify it for yourself. Hey traders, you've been asking for it, and it's finally here. The 2-month SMC Trading Mastery course drops this November 1st. This isn't just another course, it's a complete system to master smart money concepts, manage risk like a pro, and build consistency in your trades. And here's the crazy part. It's only $500, plus 61% off for pre-bookings before November 1st. Oh, and we're giving away 5 $100,000 funded accounts to our students. Don't wait, click the link, secure your spot, and let's make this the turning point in your trading journey. See you inside. Now, let's move on to the next candle. This type of candle is known as a reversal candle. Many traders also refer to it as a hammer candle or an inverted hammer candle. In this formation, the wick is significantly longer than the body, indicating strong price rejection. For example, here's a 5-minute time frame chart. The price gets rejected from higher levels and approaches the psychological mark of 25,000, forming long lower wicks on the chart. These are rejection candles. In this pattern, the price opens at a certain level, drops below that point, but after facing rejection from the lower level, closes near its opening price. This shows that sellers initially pushed prices downward but couldn't maintain control at the bottom, meaning buyers stepped in with strength to push the price higher. In this chart, buyers have made several attempts, about 3 times, to lift the price from the lower level. Also, the candles are getting smaller as they move downward, signaling that sellers are gradually losing their dominance. If the price manages to close above the last red candle, we can plan a reversal trade. Soon after, when the price moves and closes above that level, it becomes our entry point. Since buyers have now taken control from sellers, the price moves upward with strong momentum. The opposite happens in a bearish reversal, where the price rejects higher levels and starts to fall. When the market approaches a key zone and begins forming long, weak candles, with support below and resistance above, it signals a strong probability of a reversal. However, you should avoid entering a reversal trade until the price breaks out of its range. Once you do enter, hold your position until a candle closes outside of the rejection area, as this zone acts as support and helps protect your stop loss. Therefore, maintaining your stop loss with discipline is crucial. Now, let's move forward and understand our third candlestick. These types of candles are known as indecision candles. They form on market charts when both buyers and sellers are uncertain or hesitant about the market's next move. In this candle, the price closes near its opening level, showing very little overall price change. Long wicks appear on both sides of the candle, and price movement remains minimal. This indicates that neither buyers nor sellers are in control. Such candles appear on charts during periods of market confusion or lack of clear direction. Whenever a strong bullish or bearish phase is nearing its end, the market's momentum starts to fade as volatility decreases. This leads to consolidation within a specific price zone. During this consolidation phase, multiple indecision candles tend to form on the chart. If a long lower wick candle is followed by another candle with a similar long upper wick in the opposite direction, it also represents indecision. By marking the closing prices, highs, and lows of both candles, you'll clearly see an indecision zone forming on the chart. This pattern shows that buyers first push the price higher, forming one candle, and then sellers push it down from the top, closing near the same level, forming the second. This behavior reveals that both sides are uncertain about where the market will move next. Therefore, until the price clearly breaks above or below this zone and closes beyond it, you should avoid entering any trade in either direction. Whenever you analyze a chart, use the candle size to gauge price momentum. For instance, in this example, the price drops sharply, forming large candles between these two levels. But as momentum fades, the candles become smaller and start forming long wicks on both sides. This indicates that sellers are no longer interested in adding fresh short positions, leading to a slowdown in market movement. This also means that the chances of the market continuing downward from this point are quite low. Unless the price consolidates here for a while and new sellers step in, the probability of a further decline remains limited. Additionally, fake breakouts are highly likely to occur in this zone, trapping retail traders. That's why it's crucial to understand the psychology of buyers and sellers behind each candle and candlestick pattern that forms on the chart. Only then can you avoid getting trapped in false moves. That's it, traders. Thank you for watching this video. If you're still here, it's not by chance. You're here because you're serious about growing. So don't just scroll past. If this video truly added value to your journey, hit that like button and show some support. And if you're new around here, make sure to subscribe and turn on the bell, so you never miss what's coming next. Remember, progress doesn't come from luck, it comes from awareness and consistent action. Keep your standards high, your goals clear, and your excuses quiet. I'll catch you in the next video.